In the last unit of the module, block 1, we'll be studying today about investment theories. We have already covered first a brief idea about what is investment, then we learned about the securities market from where you will buy or sell, and finally yesterday we understood about the risk and return. These are the preliminary things we need to know. After knowing this, today we'll be learning about investment theories. There are different theories of investment, and it will be, I hope it will be an interesting session that you will learn a lot about the market also. So let's move to the objective of today's session. You can explain the concept of market efficiency. Market efficiency in the sense at any time all the informations and other things are processed and price is determined. You will differentiate various forms and degrees of market efficiency. Sometimes a person in Bombay, he has more information, but a person who is trading from Bihar may not have that information. So various forms and degrees of market efficiency. For him, market is not, he lacks some information. And then undertake various empirical tests of market efficiency, which you'll get into your material given by IGNOU to you. And finally, we'll discuss the implication of efficient market hypothesis. It's very important that market should be efficient in the sense the information, different information based on which you will, as I told in the very first class, you'll do the security analysis and other thing. You need all information with you. Otherwise, anybody who has a more up-to-date and better information, they have an advantage over this. So let us be very clear what we are going to learn in today's class. So there are investment theories. Different investment theories over a period of time has come out. Many people have done a lot of research, and over a period they have done some empirical studies and developed different type of formulas to guide the investors in making investment decisions. Some of the most prominent ones we'll hear here: efficient market hypothesis. It is, as we'll come to know later on, Eugene Fama, he got a Nobel Prize for that. He has studied and understood the market efficiency. Next is random walk theory. Random walk theory is basically a group of people who think, or researchers who think that market moves in its own way. You just can't predict based on that movement that he will go which side, another side. Some people call it a drunken man walking in the street. You just don't know where it will go. Besides that, there are modern portfolio theory. There is value investing. In short, which is now the price and the intrinsic value of the company is good, but now it is trading at a low price. So you identify those stocks and you invest in those stocks, because once the market discovers the value, you will get the price will move up. So you will make money. So that is called value investing. Okay, I can give you an example of Titan. It was at 76 rupees, but people didn't realize that it's a Tata brand. They were getting into gold business, and there was no branded store nationally who were selling ornaments, jewelries, gold jewelries. So you need a lot of trust and faith, which people had with Tatas. So the share was trading at 76 or something like that. And when people realized slowly pan-India, the price went up to 3,000. So that is when somebody invested in that, he really made good profit. So this is called value investing. Next, we come to growth investing. The growth investing is very often nowadays you find people are investing in Paytm, in Zomato, in Swiggy, when companies are not making any profit. So why you are making investment there, or those who are making investment, those who are proponent of this type of theory, they say, "Okay, look, buy this company now, they are growing, and once the growth phase builds up, they will be earning a lot of money because they will have some sort of monopolistic presence in the market." And you can see now, besides Zomato and Swiggy, there is no other distributor or somebody in that food delivery. And they're not only food, they're delivering a lot of other things also. So when they are capturing the market, they will be giving a lot of profit. It is expected. As I told you, everything we think that in future it will occur. And finally, the behavioral finance. People have certain behavioral instinct to some stocks and securities, and you think that these companies will go up or give a better profit. Like you see, there is a change in attitude in the people that companies which are ethically good and those who are making sustainable products, organic products, they will be doing good business in future. So this some sort of behavioral pattern comes in here because you are an ethical person, you believe in organic eating or something like that. So you will like to buy those stocks, and inshallah, maybe you'll be making good profit. So each theory, as I told you, six theories, has their own strength and weakness, and there can be arguments. And there are different studies on these theories. In this unit, we will concentrate on EMH, which is efficient market hypothesis, and random walk theory, from which the other things you can work it out. So let's move to the next slide. Now, concept of market efficiency. It's 1953. One gentleman, Morris Kendall Lew, he found after studying there exists no pattern or in the movement of share price. It just moves. Sometimes up, sometimes down. It's like that. But Eugene Farmer, the professor in Chicago, 1960, he did a meticulous study, and he found that well-informed and intelligent investors will be appropriately priced and reflect all available information. In an active market, the person who is reading the annual report and other things and etc., they will buy the stocks and other things, and securities will be priced accordingly, because if it goes up, they will not buy because they know this company can make this much of profit. So the price in the market will reflect all available information. Note the point, all information available. So this is some sort of efficient market. So next parameter, an efficient capital market is a market that is efficient in processing information and prices fully reflect all available information. Coming last, William Shaw, another researcher and who has done a lot of studies on this, stated that a perfectly efficient market is one in which every security price equals its market value at all times. In the last slide, I talked about value investing so that you know that company has a very big future, but the price in the market is low. So I can make some super profit. But from this efficient market hypothesis, at any time, all the information are there with you. So you know how much money company will be making, what is the profit will be making, what will be the market share of the company, what is the government policies on that thing. So you really cannot make super profit. So that is an efficient market when everybody is at the same platform with same information and all the data, etc., with them. That is the concept of market efficiency. Okay. Theoretically, please try to be very clear about it. An efficient capital market is a market that is efficient in processing information and prices fully reflect all available information. There may be time gap. Today, just now, maybe the finance minister announces something, and within a few fraction of seconds, there is a buying and selling, and the priced, we call it, the stock is already priced in on the, or the news is already factored in. So you get a new price which is based on that information. So this is the concept of market efficiency. I hope you will learn it here. Now, there are different forms of market efficiency. Efficiency has different levels, as in anywhere. Everybody is not same efficient. Similarly, market is not equally efficient. So there are three forms, Eugene Farmer said. One is weak form of efficiency, one is semi-strong form of efficiency, one is strong form of efficiency. I will discuss with you today all the three, and you will understand when you analyze a stock which type of market in the market where you are dealing is. So let's learn. Weak form of efficiency. The weak form means that the current price of stock fully reflects all information that is contained in the historical sequence of price. What does it mean? In other words, weak form of efficiency implies that you cannot make excess profit by trading on past trends. Okay, because informations are available, company has made this much of profit, company has sold this much of goods, market has grown this much, etc., etc. This is a weak form of efficiency because this directly repudiates technical analysis. You know the technical analyst, and we'll also know more about them later on. They study the pattern of price movement, historical price, and then they think that if it moves like this, then in future it may move like this. So they have some data. We'll learn about it later on in different models. Moving average, momentum, volume of trading. If a lot of people are trading in this particular stock, there is a momentum. If the average price is going up, and then will it keep going up or not? This all is not a meaningful analysis for making abnormal trading profit if the markets are efficient in weak form. So if we go by the logic of weak form of efficiency, then we really do not consider the technical analysis made you. The people who trade, they can make profit, which is quite not acceptable argument, I should say. So I hope I have made it clear. Just note that weak form of efficiency may you all have historical data only, and it is available with everybody. And based on that, there is a price in the market. Now, next, semi-strong form of efficiency. We'll learn all the three, and then we'll go about thinking what to do. Market is called semi-strong form efficient if all information available in annual report, bonus, or rights information, news clipping, macroeconomic data, etc., which are with public are reflected in the market price. Now here we are coming a little forward. What we are saying, that annual report में जो है bonus या right and information के बारे में information is there. There are some news has come out in Economic Times Bombay edition or some local money magazine, Money Control, etc. Or some macroeconomic data has been published by Ministry of Statistics and Program Implementation. which are with public. So that has been, since it is with public, so it has been taken care of, and market price buying and selling has happened, and market price stands taking into consideration these information. But is it possible? There must be subtle shades of semi-strong market efficiency, but they are not typically differentiated. What do I mean by that? There must be subtle shades of semi-strong market annual report, information of bonus or something news information that might be there, but there can be some information which are coming, or which have not reached you, or some information the company has not yet declared. So though those information has been with the public, but selectively it is not with all the public. So this is a very dicey situation. I hope you have understood that as per theory, that information available in different places are available with all the public, and naturally they have bought and sold the share accordingly. But is the information available with all the public? Some government policy, maybe it's known to the public who are in the government department, or SEBI is coming out with some rule, it is known to these people who are making those rules. Or a company which is going to come out with some new product, information is with the companies, those people who are working in that department, or more so, strategic people of the company. So that is why semi-strong market strikes at the very heart of analyst profession. Now, if you are a security analyst, you do analyze one security. Say, I analyze one particular security from all angles and come out with an expected price. And I find the present price is low, so it's going to go high. But suddenly you come to know that no, government is planning something else. So the product or something like that of the company may not happen. So naturally the price will not move. Those who have that information. Hope I'm clear. So this puts the analyst in trouble. So taste of semi-strong have dealt with the speed at which market participants react to public release of new information. So mind the words, public release of new information and speed at which market participants. So if the information company headquartered in Mumbai shares with somebody, Mumbai brokers will be knowing it very fast before somebody in UP acting on that, or somebody in Kerala acting on that, and the price is automatically adjusted. So this is a semi-strong form of efficiency. Yes, information is there with the public, but not necessarily with all public. So the analyst is in a sort of dilemma, whether this information has already been priced in or not. Suppose as an analyst, I want to give this information that price is going to go up, but somewhere information is already there and price has gone up. So my analysis is no more valid. This is the problem with the semi-strong form of efficiency. One has to be very alert that which information has already been factored in. Empirical evidence generally supports the contention that the public reacts quickly to information. Now that many of you who are in touch with the market and other thing, we know we react to the information very fast, and what happens in the process is that sometimes we take a wrong judgment, we sell the shares, or just we panic, or we are And then you see that now the information was not right, or the information was not in the properly read, and the price starts moving up. This happens many times during the budget time. We just listen one line in the budget and we think that, oh, the stock is going to go down. But when the fine prints comes out, then we find, no, this is not going to be affected, and the price again goes up. So some people make money and others, they lose money. And for analyst, till he gets all the information, it will be difficult. And when he gives the call that buy this shares, this is the price, another thing, he or she has to know that whether this information is already in the public place or not. This is a semi-strong form of efficiency. Is it clear? I hope so. Now, strong form of efficiency. Now we are reaching the best. The strong form of efficiency, all forms of information should be with everyone, be it public announced or insider news. No one has any information which is not already factored in market price. That means if Tata Steel is planning to take over Bhushan Steel, this information is available with everybody. But you do not know, when Tata Steel was planning to take over Chorus, only the core strategic team might have known. So the hypothesis here is, or the main understanding here is that all forms of information should be with everyone. When I say everyone, Kashmir to Kanyakumari and Guwahati to Gujarat. So all forms of information should be with everyone, be it publicly announced or insider news. So if government or Ministry of Finance is going to change something, or RBI going to increase the interest rate, this information should be with everybody. No one has any information which is not already factored in marketplace. Honestly, few people believe that there is a market which is strong, form efficient. But it's nice to have this benchmark. It's technically not feasible, perhaps, to have all information with everybody at the same time in the market. Now the hypothesis, the Eugene Farmer and others says, the strong form of hypothesis, EMIH in short, is of two types. Super strong form. Okay, this is super strong form. I'm sorry. Super strong form, which includes insider and specialist who possess monopolistic information, right? And near strong form, which includes private estimates developed by who possesses information, financial analysts, portfolio managers, and other thing. So in this strong form efficiency, only selected people can pass. Those who are insiders to the information, the board of directors, or those strategic people who are designing something, specialists who can guesstimate properly, or those who have monopolistic situation that yes, they can go ahead with this, that is super strong. Near strong, because these people will depend on the information flowing from those super strong people, that estimate developed by, because the information I have from the first people, super strong form, the financial analysts, portfolio managers, etc. So they will take position and buy the stocks or sell the stocks earlier, and because that time the price is already factored in this information. So theoretically, super strong, the strong form of efficiency sounds very good, but in reality, it is very difficult. At a particular time, you will all realize if the same information which is insider as well as outsider, public announced or insider, will be available with everybody in the market at the same time. If, if it is there, then nobody can take the arbitrage opportunity, or the price volatility will be not there because price already has that information. So it has been already been priced in, as we call it. But if you are very close, you are a director in a company and other things, then, and if you are sharing that with your friend who is an analyst or something, they have those all information. So they will buy and sell, and price will be a new price. And there you cannot make any more profit, or it's properly valued. At that moment, the stock is properly priced or valued. No more hidden value is there. That's a strong form of efficiency. So we have studied about weak form of efficiency, where only past data are there. Second is that semi-strong is past data as well as some of the future projections and other things, etc. Future mein kya ho sakta hai, all this information are there. And strong form efficiency mein we are saying that all information, insider, outsider, publicly available, available with the restricted people, everything is available with all the public. And accordingly, market price has been settled. Now, after understanding the efficiency market, these three forms of efficiency, efficiency market hypothesis, these three forms, let's move to the radically different one, random walk theory. Now this is entirely different. Here there is no analysis and other thing, etc., etc. This theory asserts that price movement will not follow any pattern or trends, and that past price movements cannot be used to predict future price movements. As I told you earlier, a technical analyst, they do analyze and they do make profit also, analyzing the past movements. Now, what are the features of random walk theory? Stock prices are arbitrary, and as a result, a stock prices or market's historical movement or trend cannot be used to forecast its future movement. Because you do not know how it will react to the future events, though you know the past pattern. Now, markets cannot be outperformed without additional risk. Now, if you're ready to take additional risk, then perhaps you may be outperform the market. Outperform the market means if index or something market gives a return of 15%, you get a return of 18%. That is outperforming the market. Third point is very interesting. Fundamental analysis is deemed unreliable because you are doing something which is very erratic, and say I am doing a fundamental analysis because of frequently subpar information gathered. You're not getting all the information because it's a random market and it is susceptible to misunderstanding. So their movement of the market in this direction or that direction can send a different type of signal, and you will be doing your analysis based on that signal, so it may come wrong. So that is the statement of the proponents of random walk theory. Financial analysis there is no point, because based on which you are doing the analysis, you do not know why that movement has taken place. The fourth and the final factor, investment advisor don't significantly improve an investor's portfolio. Now that's those who are studying security as analysis, portfolio manager, and will be investment advisor, is a direct hit to them, that you don't significantly improve an investor portfolio. In fact, this is an arguable point. There can be argument from both sides. If you can study the movement of the market, past movement with proper analysis, and now a lot of statistical tools are available based on that, and a lot of forecasting tools are also available, and you can understand the macroeconomic movement, industry movement, and then you can make a reasonably good analytical projections about the security of the stock, and you can deliver. The investor can get a little or opportunity to make money. But random walk theory thinks that because the past is erratic, all this your analysis and other thing may or may not give a good result. Now come to the last bottom. The random walk theory is still a widely accepted concept in the field of financial economics. So in spite of all these things, it is a widely accepted concept in the field of financial economics because if you study the past movement and other thing and observe, then to some extent you can predict what will be the movement in the future. It's just like suppose you are watching a little kid making her first baby steps. If you observe very frequently, then you can guesstimate at what time he can fall or he will manage himself. So this is where the random walk theory proponent says that yes, after looking at the few past data, you can perhaps predict some more future movements. And on this field, a lot of financial economic research is going on. Despite opposition from those who think there are practical ways to predict stock values and beat them. What is that practical way? That is, you analyze the stock, you study the macroeconomics, you study the industry, you study the company, the management, their financials, and etc. And you can buy the right stock and make money and beat those who are studying the random walk and trying to predict the future price and making money. In fact, both sides had their argument, and honestly, both sides make money, but in the long run, the research says it is those who are following that analysis and macroeconomic data, etc., they make more money. Well, I am not going to take any name, but some of you have heard about Ramdev Agarwal in India, with Motilal Oswal and other thing, who is a proponent of this study, research, analyze, and then invest. And on the long term, he has proven himself. But similarly, there are a lot of unspoken heroes are there who does the short-term random walk theory predictions and other things, and they also make some money, like the speculators and etc. I hope you remember here I talked about speculators. Yes, they also do make money. Sometimes more, sometimes less, but on an average they make less money. That's what the study or research says. With this, we have covered the two theories of the market or investment theory which we wanted to discuss in details. One is a strong form of theory or efficient market hypothesis. Another is random walk theory. There are a lot of statistical analysis are there to prove or establish this arguments in statistical way by studying the market over a long period of time, at the same time following the information flow in and out from the market. That's called market microstructure. I'll just like to share with you. Suppose over a long time you are studying couple of stocks, so five stocks, and on the other side you are keeping an information. What is the information coming in the market and how the price is moving? If you study this pattern over a period of time, you will understand that yes, if this type of information is there in the market, at that moment the price can move like this. Now you must be aware whenever you're talking about a future, there is some amount of uncertainty or risk. But if you are studying and predicting, the risk comes down rather than arbitrarily if you are doing that. So I have seen investors who are regularly watching and also checking the flow of information. You can also do, because nowadays in the National Stock Exchange or any other screen, you will find there is a lot of information scrolling, and they are giving this information. But they do, and then the price is either moving up a little or moving down a little, depending on the information and how some people have behaved. Maybe some people have first dumped the shares or sold the shares, and later on some people have bought the shares, the price has gone up. So you can understand the pattern, and then you develop a little bit of expertise in that, and you also start trading on that theory. That is what I am saying here, is that random walk theory. So you use this and try to make short term gain, because the price which has fallen will go up, and how much time it generally takes your some time, long time, in the sense couple of months or years study will tell you that okay, you price has gone down, you buy it, maybe another couple of days or other thing price will move up, and it happens. Maybe your study says that it will move up by 10 points, but it doesn't move 10 points, it moves 7 points, because by that time some sellers come in, but still you have gained 7 points, and you make some money. So what I'm saying is now is the same thing which I told when I discussed about the speculators and investors. A typical investors who has studied the stock, analyzed it, another thing, he will remain invested in the stock even if it goes down, because he knows it will come up. He looks at the broad picture. Okay, so only when some more information comes in, he or she can change his position. This is the advantage of knowing the market you are operating in, or the stock you are operating in is in a semi-efficient market way, or weak market way, or strong market way. Generally, large cap stocks information are very available type of things. It is small cap and mid cap way. You have lack of information. What do I mean by that? That means small cap, all mid cap or micro cap may, many informations are with the promoters and the closed groups, their suppliers and other things, because press and public do not cover them fully or daily, another thing. But something happening to Larsen to Bro or Tata is then and there known to all India, all today. But if something happens to a small company, jumbo banks, nobody knows. So you can make some profit there, perhaps, if you are studying those stocks regularly. So you must know when you are in the market, the stock is, it is not the whole market. It is the market which is relevant for the stock, how it is behaving. Whether you have all information or you have some information or the public has all the information, it is priced in, or no, you have some information which public do not know. When public will come to know, the demand for the stock will come and the price will go up. So you enter when public do not know, but you know. So that's a weak form of where you can make money. And that is what Indian market was earlier. And then Indian market moved to the semi-strong because SEBI has become a very strong guard on insider trading and other things. So if insider has some information about, say, Tata Steel or some company, Reliance will give a bonus issue. Now, some people in the Reliance, in the CFO and etc., those goes to CFO's room, they might be knowing it. They may be sharing with their friends. So some circle might be knowing and they are buying the shares. And ultimately their bonus declared and the price goes up. So they make money. So this becomes some sort of insider trading. And SEBI comes very strongly on that and either ban those traders or they are expelled from the market for some time. And these penal actions are reducing this information arbitrage in the semi-strong market, right? Now let us go to the anomalies of efficient market hypothesis. Apparently it sounds good, but let us see. Securities market are flooded with thousands of intelligent, well-paid, well-educated investors. Now, why I am saying well-paid, well-educated investors? Because the institutional buyer, I told you in the very first day, there is a segment which is institutional and individuals. Now, individuals also not well-paid, but well-educated. They may be, they are intelligent, and the mutual fund or the foreign institutional investor or domestic institutional investor like LIC and other things, they are keeping a band of people who are quite intelligent, well educated about the securities market, they're paid well. For what for? Finding out the value of the stock and what is the price of the stock, whether it is underpriced or it is overvalued. Like foreign investors now, they say Indian stock market is overvalued. They are selling and getting out. Today, yesterday, there was a huge market fall because foreign investors think that Indian stock market is overvalued, so they are going out. And some other reasons might be, but that's one reason. The more participants and the faster the dissemination of information, the more efficient a market should be. So this is what we have learned earlier. However, the researchers have documented some technical anomalies. Now, what is the technical anomalies? First is, let us understand the technical anomaly, that is, the majority of researchers that have tested technical trading systems have found that prices adjust rapidly to stock market information and that technical analysis techniques are not likely to provide any advantage to investors who use them. So their argument is that if there is any information available in the public, immediately the price will go up or come down. So if you're following a technical analysis who generally say buy at this price, prices like to go at stop loss, etc., that will not work because at the speed at which the information comes and people, so many people are acting and the price is adjusting. Once again, I would like to say, information comes in And so many people are getting this information and they are taking position depending on buying and selling, etc. And very soon stock moves and then settles because the information is already plugged in, factored in into the price. So if you are following the technical analysis that when price will go and everything, that may not work. So that's what they're saying here. Not likely to provide any advantage to investor who use them. However, others argue that there is validity to some technical strategies. Yes, there are some technical strategies are there, but in any case in market you have to act fast. Number one. And number two is that if there is a breakout point or something, the price will move up. It is not likely that it will be, if I have said you that price agar, if it comes to 30, buy, it will go to 60. Now you may say the price has come and it looks like that it will 30, 29 or 31. So you wait and then you buy and then you don't wait for 60, maybe 36, 35, 35. There are other buyers who has purchased it later. Their expected return is less. They are less risk takers. They will sell. So price cannot go up to 60. So you have to act fast to get the benefit of the technical strategy. So this is very important. You have to be in the market and watching the stock, the understanding the technical strategy recommended to you, and you have to use it so that the tactics is yours. The strategy is the technical analyst. He has studied and he has given some band, key price, stop loss, another thing, etc. But on the screen, on that moment, the tactics has to be yours. When I get in, when I get out. Now that also depends on your risk appetite, your risk tolerance, etc. Because technical analyst report does not know what is your risk taking capability, what is Mr. B's, what is Mr. C's risk taking capability. I hope I have made this technical anomaly point clear to you, because many of the people in the market are playing based on technical analysis. Playing in the sense they are buying stocks and selling stock based on the technical analysis. Now here you have to use your analytical thing also, looking at the market at that time. So in some broking houses you will find during the market hours there are calls coming for some duration. Morning there are calls coming which may affect in the morning first hour, and by the time you come up at 11 o'clock, information is done, price is already reached. Sometimes information comes during the trading hours. So if you do not act, there are millions of participants who will act there. Somebody as a seller because they are booking their profit. Somebody is a buyer because they want to take a position, and sooner or later the price will be there where the technical analyst expected it to be, or it do not reach that point because of the risk factor of the traders. So you have to understand that, and then you should be buying or selling the stocks. This is the second last line of the argument. Argue that there is validity of some technical strategies. You just can't root out technical analysis. At least that's my hypothesis. My thesis is that. Next is you will come to fundamental anomalies. What is fundamental anomalies? Let's see. There is a large body of evidence documenting the fact that historically Investors mistakenly overestimate the prospect of growth companies and underestimate value companies. Now, I have to give you an understanding. Many of you might be having it, but I'll tell you what are growth companies, what are value companies. Growth companies may not be making money now, but they're growing fast, and at a particular time, perhaps they will be a dominant player in the market, in the segment they are working. So they may not be giving dividend, they may be making loss as of now, they are just investing money into the growth. These are growth companies. So their PE and other things will be quite high. On the other side, there are value companies, which, if you study properly, value analyst you are, you see that this company should have been valued more. But the market doesn't notice it is valued at low. Price is low. Price and value, that is the difference. Price is what market determines. Value is how you perceive or your analysis shows. So these are the value companies. But what happens? First, let us come into growth companies. Sometimes this analyst and large body of evidence is there that we overestimate the growth story. Okay, you remember I think we had a company called Snapdeal, like Flipkart and not Amazon, because it was born out of India only. People thought it will grow like anything, but then it did not. I'm not talking about Snapchat, I'm talking about Snapdeal. So people estimated growth, big growth. And there is another company in the startup space, Pharma Easy or Farm Easy is the name. They were valued at 40,000 crores, I believe. I may be wrong, but valued like that. They acquired the company, which is not Dr. Pathlev. It's some other name. It is a lab, diagnostic lab. They purchased that company with 4,000 crores rupees. And people were thinking that pharmacy is going to be the next big player in the online medicine place. But within 5 years or 4 years, everything went for a toss. So we overestimate the growth prospect and ultimately we lose money. So there is an anomalies. You think there all information available with you, but it is not. You didn't know inside the company what was going on, which was growing at a fast pace for the first 5 years. What happened in the 3 years? Next, that it really went out of the market almost. So this is one problem. Second is investor mistakenly underestimate the value companies. Value companies में क्या होता है? We do the valuation of the company. We expect the company will be doing very well. It is growing. It will be like Pantaloon or that time Future Retail. Everybody estimated price was 1,009 rupees. That they are the first comer. They have big shops and other things and etc. And they will be selling. Why market? Market was giving low price actually. But then market price started going up, and then ultimately company went for a toss. They had to sell off to Reliance Retail. So we are overestimated the company's prospects without going through further developments. Sometimes we underestimate the companies. I'll give you a name. Like as of now, Hindustan Aeronautics Limited. Now, they are into aeronautic field. We know there is a lot of aerospace. things are happening from the government end, other end, and Hindustan Aeronautics Limited is the sole big player in the market with the capacity, with the technical people, etc., etc. So tomorrow maybe it will be delivering or people will realize the value. But this is not my suggestion. Please don't go by it. Consult your whoever is your consultant and other thing. But this is what I was giving as academic example, underestimating value companies. So these are the things which defy these anomalies in this efficient market hypothesis, that all informations or more informations are there, but still the price does not give the value. The value and price, it should match. Third comes the interesting thing, calendar anomalies, turn of the month effect. As the month comes to an end, there is what do you call it? Derivative. They are winding up positions and other things, etc. So price do not behave the way it should be behaving. Same thing, Monday effect, because of the Friday closing and Saturday, Sunday, throughout the globe, many things happens. Monday, you do not know how the market will open or how the market will function, because the timing factor. When Hong Kong gets up, when Singapore gets up, then we get up, then the Middle East, then the Europe, then America. So throughout Monday, everybody will wake up with the new information about which has happened on Saturday and Sundays, and they can react in the market in a different way. So they may not follow this efficient market hypothesis or semi-strong market hypothesis or all these things. So there is an anomaly. These things are happening. Basic thing you have to keep a notice on when you are into the stock market. We are into the first phase of our study, module 1 May. So these are the areas which you should be keeping your eyes on. Now, implication of. So you may question me, sir, you have taken 1 hour to explain this hypothesis, but what is the net outcome? What I learned from here? You learn 2 things. One is that if proper analysis and other things you buy and the information is there, is it possible? So the question is that the price and value matches. Question from you might be there, is it possible to outperform the market? My answer is, if you believe the market is efficient, then passive investing or index investing, because Nifty will move. You don't have to do anything extra. If you think that all information are available with the people or reaches to the people in a short period of time. But if you think the market is semi-efficient, all information do not flow, then you can pursue as an active portfolio management. You can take a call that no, this stock I put into my basket, this stock I remove from my basket, and etc. So choice is yours. The theory is here, but using it is your choice. With this, I come to wrap up today, because with this unit we are coming end of the first module. We have discussed about different type of stock markets which are less efficient, etc. We discussed about random walk theory, and all this will give you an idea about the stocks you watch and keep watching. That gives you a lot of understanding about the market movement. Earlier in this module, we have already covered basic understanding about investment in Unit 1. In Unit 2, we have covered security market framework and participants. You must learn about them. And third is, we have covered risk and return, which is very important. How much risk you can tolerate, and accordingly how much return you can expect. So these are the basic building blocks of securities market and portfolio management, which we have covered so far. And we are coming to an end of our first module. So please wait for our next module. In the meantime, go through the IGNOU materials. Thank you. Wish you all the best and happy stock market trading.